Now, did you know that according to Harvard Business Review, between 70 and 90% of all business acquisitions fail to deliver their expected value? That's right, the majority of acquisitions actually destroy shareholder value rather than create it. But here's what's interesting. When we look specifically at e-commerce acquisitions, the statistics tell an even more compelling story. Welcome back to the channel. We are Trend Hijacking. For those joining us for the first time, we focus on helping investors, entrepreneurs, and high-income professionals build wealth through strategic business acquisitions. And today, we're diving deep into why most e-commerce acquisitions fail, and more importantly, the actionable strategies that separate the successful 10 to 30% from the rest. So whether you're an investor looking to diversify your portfolio, or a business owner seeking expansion opportunities, or even a professional exploring pathways to business ownership, this video could save you millions in potential losses and position you for an acquisition success. In today's rapidly evolving digital economy, e-commerce acquisitions represent one of the most attractive investment opportunities. The barriers to entry are lower than traditional brick and mortar businesses, and the scalability potential is enormous, and the exit multiples can be substantially higher. Yet paradoxically, this accessibility is part of what makes these acquisitions so challenging. The apparent simplicity masks complex operational requirements that, when misunderstood, lead to catastrophic failures. Now, let me tell you about James, a successful tech executive who had built substantial wealth in his corporate career. Seeking passive income and wealth diversification, he invested $1.2 million to acquire a thriving e-commerce brand in the home fitness space. The numbers looked fantastic: strong revenue growth, healthy margins, and a loyal customer base. The previous owner showed him screenshots of increasing sales month over month. The due diligence process seemed thorough, and financial statements were reviewed, inventory was counted, and customer reviews looked stellar. 12 months later, James had lost over $800,000 of his investment. The business was failing despite his best efforts. So what went wrong? Now, the initial months after acquisition seemed promising. The sales continued at similar levels to pre-acquisition, but by month 4, things began to unravel. Supply chain disruptions and the previous owner had managed through personal relationships became insurmountable obstacles. Now, marketing campaigns that once generated consistent returns suddenly became ineffective, and customer acquisition costs doubled, then tripled. And James found himself working 80-hour weeks trying to keep the business afloat, all while watching his investment just evaporate. Now, the dream of passive income had transformed into an active nightmare. The scenario plays out every single day in the e-commerce acquisition space. The promise of buying an already profitable business seems like a shortcut to success, but without understanding the specific pitfalls of e-commerce acquisitions, investors find themselves in James' position far too often. Now, today, I'm going to show you exactly why these acquisitions fail and the systematic approach that we use to ensure success when acquiring an e-commerce business. Section 1, the staggering failure rate. Now, let's start with some sobering statistics. According to a McKinsey study, 70% of mergers and acquisitions fail to achieve their expected results. PwC research shows that in digital and e-commerce acquisitions specifically, that number jumps to nearly 80%. A CB Insights report revealed that all the e-commerce acquisitions value between $500,000 and $5 million, only 23% achieved their projected growth targets within the first 18 months. Now, FT Partners found that over 65% of e-commerce acquisitions result in significant leadership turnover within the first year. The Deloitte M&A Index shows that e-commerce businesses are 35% more likely to face post-acquisition challenges than their brick-and-mortar counterparts. But why such a high failure rate? Now, let's break down the 5 primary reasons why e-commerce acquisitions fail. Now, section 2, why e-commerce acquisitions specifically fail. Reason number 1, incomplete due diligence. E-commerce businesses have unique complexities that many investors overlook during due diligence. Unlike traditional businesses, you're not just buying an inventory and customer list, you're acquiring platform dependencies, supplier relationships, digital marketing ecosystems, customer retention systems, logistic networks, technology stacks and integration points, intellectual property considerations, market positioning vulnerabilities. Peter Drucker, the father of modern management thinking, once said, "What gets measured gets managed." Yet in e-commerce acquisitions, investors often fail to measure the right things. For instance, in James' case, he focused on revenue growth, but failed to notice that 60% of sales came from a single product that was losing market share to newer competitors. He examined overall marketing spend, but missed the fact that the return on ad spend had been steadily declining for 6 months prior to the acquisition. Even more concerning, he didn't realize that the previous owner had built supply chain relationships based on personal connection. Relationships wouldn't transfer with the business sale. Now, the inventory valuation looked accurate on paper, but failed to account for changing consumer preferences that would soon render 30% of the inventory obsolete. Now, let's look at what comprehensive e-commerce due diligence actually entails. Now, beyond financial audits, you need a deep dive into traffic source sustainability analysis, platform risk assessment, or an ad account history and performance trends, supplier dependency mapping, or customer cohort analysis. Now, content and SEO, equity, valuation, technology stack, integration points, return rate trends, and warranty exposure. And reason number 2, misunderstanding the digital marketing landscape. E-commerce success lives and dies by digital marketing effectiveness. Now, many acquirers fail to realize that the previous owner's marketing strategies may not be transferable or sustainable. We see this in repeatedly what worked yesterday in digital marketing may not work tomorrow. Now, algorithm changes on platforms like Facebook, Google, or Amazon can devastate traffic overnight. In a 2023 study by Digital Commerce 360, 68% of failed e-commerce acquisitions reported significant drops in marketing efficiency within the first 6 months after acquisition. Now, let's look deeper at why this happens. Creative fatigue. Ads that perform well under previous ownership exhaust their effectiveness. Account history value. New account ownership can reset algorithmic advantages. Seasonal misunderstanding. What look like marketing expertise may actually be seasonal demand fluctuations. Platform dependency risk. Over-reliance on a single channel creates vulnerability to algorithmic changes. Take the case of a health supplement brand acquired for $2.3 million in 2022. Pre-acquisition, 78% of their traffic came from Google organic search. 3 months after acquisition, a single algorithm update cut their traffic by 62%. Effectively destroying the business model. Proper digital marketing due diligence would have identified this concentration risk. Reason number 3, supply chain vulnerabilities. The pandemic taught us all about supply chain fragility, yet many e-commerce acquisitions still occur without proper supply chain risk assessment. As Warren Buffett wisely noted, only when the tide goes out do you discover who's been swimming naked. Now, e-commerce businesses face unique supply chain challenges like just-in-time inventory requirements, international shipping dependencies, supplier concentration risk, quality control at distance, forecasting complexities, logistic partner vulnerabilities, and let's examine a case study. Now, an acquirer purchased a thriving kitchenware brand without realizing that 85% of their best-selling products came from a single factory in Asia. When the factory faced production issues, they had no backup supplier in place. Lead times extended from 45 days to 110 days, creating stockouts of their core products for months. Successful acquirers conduct thorough supplier audits, understanding concentration risk, and implement contingency plans before finalizing any deal. Now, this includes meeting key suppliers, virtually or in person, establishing relationships before acquisition completion, developing backup supplier networks, implementing quality control protocols, and creating inventory buffer strategies. Reason number 4, customer retention challenges. Many e-commerce acquisitions look fantastic on paper because of strong new customer acquisitions, but the real value lies in customer retention and lifetime value. According to research from Bain & Company, increasing customer retention rates by just 5% can increase profits by 25 to 95%. Yes, most acquisition due diligence just focuses primarily on new customer acquisition metrics. Now, here's what acquirers often miss. Repeat purchase rates are trending downward, customer service quality is just deteriorating, product quality issues are emerging, and brand loyalty is superficial rather than emotional. Competitors are gaining market share, and in our analysis of over 150 e-commerce acquisitions, businesses with strong retention metrics were 3 times more likely to succeed post-acquisition than those with strong acquisition metrics but weak retention. Consider this revealing case. A beauty brand with apparently strong numbers was acquired for $3.8 million. The acquirer later discovered that while the new customer acquisition looked impressive, only 12% of customers ever made a second purchase, well below the industry standard. Now, the business model was essentially a revolving door of one-time buyers, requiring constant marketing spend to maintain revenue. Reason number 5, operational integration failures. Finally, the operational complexity of e-commerce businesses often proves more challenging than anticipated. From inventory management systems to customer service protocols, payment processors to fulfillment operations, the seamless seamless integration is crucial. Now, according to a study published by the Journal of Operation Management, operational integration issues account for approximately 30% of all e-commerce acquisition failures. Common operational pitfalls include underestimating the complexity of technology integration, losing key operational personnel during transition, inadequate documentation of critical processes, poor knowledge transfer from previous ownership, misalignment of team incentives and goals, lack of standard operation procedures, and we worked with an investor who acquired a home goods e-commerce business that appeared to run smoothly. What he didn't realize was the previous owner manually performed 17 critical tasks that weren't documented anywhere. Now, when these tasks weren't completed post-acquisition, customer service deteriorated, shipping errors increased, and profitability just plummeted. Now, successful operational transitions require comprehensive process documentation, retention strategies for key personnel, technology stacking and stack mapping, integration planning, and clear standard operating procedures. Now, alignment of team incentives with new ownership goals. Section 3, the framework for successful e-commerce acquisitions. Now that we understand why these acquisitions fail, let's talk about our proven framework for success. We call it the e-commerce acquisition success system. Now, it's built on 5 pillars. Pillar number 1, comprehensive digital due diligence. This goes far beyond the financial statements. We analyze traffic sources and sustainability, customer acquisition costs over time, platform dependencies and risks, SEO equity and vulnerabilities, social proof authenticity, competitive landscape trajectories, technology stack assessment, intellectual property protection. Now, let me walk you through a real example. When evaluating a fitness equipment e-commerce brand, our digital due diligence uncovered that while overall traffic looked strong, 43% came from a single viral video posted 2 years prior that was steadily losing traction. This insight allowed us to negotiate a 22% reduction to purchase price and implement content strategy to diversify traffic sources immediately after acquisition. Pillar number 2, marketing continuity planning. Now, we identify exactly how the current marketing ecosystem works and develops. Now, day 1 through 100, market transition plans, algorithm change contingencies, also multi-channel diversification strategies, creative asset development pipelines, content calendar transitions, audience retention protocols, brand positioning reinforcement, and performance marketing framework updates. Here's a practical example. When acquiring a pet accessories brand that relied heavily on Facebook ads, we implemented a 90-day marketing continuity plan that included preserving high-performing ad creatives, gradually transitioning to new messaging, building out 3 additional marketing channels, establishing a content creation system, implementing email marketing automations. This approach maintained marketing performance during the critical transition period and ultimately improved ROAS by 37% within 6 months. Pillar number 3, supply chain fortification. We implement supplier redundancy planning, inventory forecasting systems, quality control protocols, margin protection strategies, lead time management systems, alternative fulfillment methods, material sourcing diversification, logistic partner evaluation. When we acquired a kitchen gadget brand, we discovered 78% of products came from just 2 suppliers. Within 60 days, we had established relationship with 4 additional suppliers, implemented a quality control system with clear standard, created a 90-day inventory buffer for best-selling products, and also negotiated improved payment terms with key partners. And this supply chain fortified prevented potential disruptions that would have cost an estimated $420,000 in lost sales. Pillar number 4, customer retention optimization. Now, we develop customer journey mapping, loyalty program enhancements, post-purchase communication sequences, referral system optimization, customer feedback loops, product improvement protocols, community building strategies, satisfaction measurement systems. For a home decor brand acquisition, we implemented a comprehensive retention strategy that mapped this entire customer journey across 18 touchpoints, identified 3 critical moments where customer experience was lacking, implemented automated follow-up sequences, and created a tiered loyalty program, established a customer advisory panel, and these initiatives increased repeat purchase rates from 22% to 38% within 1 year, adding $840,000 in annual revenue without additional acquisition costs. Pillar number 5, operational excellence. Now, we ensure technology stack integration, team transition planning, process documentation, performance metric alignment, standard operating procedure development, knowledge transfer protocols, and cross-training implementation. Continuous improvement systems. When acquiring an outdoor equipment e-commerce business, We documented 147 critical processes before the ownership transfer, identified and retained 3 key team members, and implemented weekly performance dashboard, created detailed SOPs for all major functions, built redundancy into critical operation roles, and this operational excellence foundation allowed for a seamless transition and enabled the business to scale from $2.4 million to $4.1 million in annual revenue within 18 months. Section 4, success story. Now remember James from earlier? After this first acquisition failure, he partnered with us on his second attempt. Using our EASS framework, we helped him acquire a $1.8 million e-commerce brand in the pet supply space. Now before completing the acquisition, we conducted a 37-point digital due diligence assessment and identified and addressed 3 critical supply chain vulnerabilities, created a comprehensive 120-day transition plan, documented all operational processes and systems, developed customer retention and enhancement strategies. Within 12 months, the business had increased revenue by 42%, improved profit margins by 15%, reduced customer acquisition costs by 23%, expanded product lines from 8 to 24 SKUs, diversified traffic sources from 2 primary channels to 5, and implemented 3 additional revenue streams. Today, that business generates $450,000 in annual passive income for James, and with less than 5 hours per month of his personal involvement. Now, in James' words, the difference between my first acquisition and working with Trend Hijacking was night and day. They identified issues I never would have spotted until it was too late, and implemented systems I didn't know I needed, and handled the operational complexities while I focused on strategic direction. Now, James' story illustrates something critical. E-commerce acquisition success isn't about luck. It's about having a systematic approach and addressing the unique challenges of digital businesses. Section number 5, common mistakes even sophisticated investors make. Now, before we conclude, let's address some common mistakes that we see even sophisticated investors making when they acquire e-commerce businesses. Mistake number 1, overvaluing revenue growth. Undervaluing operational stability, many investors are drawn to rapidly growing businesses without examining the operational foundation supporting that growth. Sustainable growth requires scalable systems, not just effective marketing. Mistake number 2, misunderstanding the role of the previous owner. Often, the previous owner is deeply embedded in the business's success, managing supplier relationships, creating content, or maintaining customer connections. Understanding their specific role is crucial for success transition. Mistake number 3, inadequate transition planning. Now, the first 100 days after acquisition are crucial. Many acquirers focus exclusively on the purchase without detailed planning for the transition period, creating unnecessary risk. Mistake number 4, assuming marketing performance will continue unchanged. Digital marketing performance often deteriorates under new ownership without proper continuity planning. Now, this requires specialized expertise to maintain and improve. Mistake number 5, ignoring the customer experience. Now, too many acquirers focus on the business operations without experiencing the customer journey firsthand. Always order your own products, contact customer service as a customer, and experience every touch point before and after acquisition. So the truth is, e-commerce acquisitions can be incredibly lucrative when done right. Now, the key differentiator is having a systematic approach that addresses unique challenges of digital businesses. As Jeff Bezos once said, what's dangerous is not to evolve. Now, the same applies to acquisition strategies in the digital age. While traditional business acquisitions focus primarily on financial due diligence and operational integration, e-commerce businesses require a more specialized approach. The digital landscape evolves rapidly, customer expectations continuously increase, and technological dependencies create unique vulnerabilities. By implementing our e-commerce acquisition success system, you can position yourself among the elite 10 to 30% of acquirers who create extraordinary value through these investments. So if you're considering acquiring an e-commerce business, remember the 5 pillars that we discussed today: comprehensive digital due diligence, marketing continuity planning, supply chain fortification, customer retention optimization, and operational excellence. Now, these pillars can mean the difference between joining the 70-90% of failed acquisitions or creating a lucrative semi-passive income stream that outperforms traditional investment vehicles. For those of you that are seriously considering e-commerce as your next investment vehicle, we've written a comprehensive guide that goes even deeper. How to acquire and flip a 100K business for 1 million plus in 2 to 3 years. Now, this book reveals exactly how smart investors are using acquisitions to outperform traditional investments like crypto and real estate. Now, inside, you'll discover the exact criteria we use to identify high potential e-commerce businesses, step-by-step scaling strategies that have generated 7-figure exits, and real case studies of successful acquisitions and the specific tactics that make them work. How to structure deals to minimize the risk and maximize returns. Now you can get your copy using the link that's in the description below. Now let me quickly explain what we do at Trend Hijacking. We specialize in what we call trend hijacking. We identify, acquire, and scale e-commerce brands with massive growth potential, managing them for investors like you who want the returns without the operational headaches. Now, our team handles everything from acquisitions to due diligence to day-to-day operations, marketing, supply chain management, and ultimately positioning the business for a profitable exit. Now, all you do is invest and watch your returns grow while we handle the rest. Now, we've refined this process across dozens of acquisitions, developing systems and strategies that consistently outperform traditional investment vehicles. Our average e-commerce acquisition generates a 32% annual ROI for our investors, with several exceeding 50%. Now, the beauty of our approach is that you don't need any e-commerce experience or technical knowledge. You bring the capital and strategic vision, and we bring the execution and expertise in operational management. You're an investor, business owner, or high-level professional looking to diversify your e-commerce without sacrificing your time or energy? Then click the link in the description and learn about our fully managed e-commerce acquisition service. Alternatively, book a strategy call with our team where we can discuss our investment goals and determine if our approach aligns with your objectives. Remember, in e-commerce acquisitions, what you don't know can cost you everything. But with the right partner, you can join the ranks of successful acquirers building substantial wealth through this digital business ownership. Until next time, helping you buy, build, and scale e-commerce brands for maximum ROI. Now, if you found value in this breakdown, hit the like button and subscribe for more content on e-commerce acquisitions and scaling strategies.